Hi everyone, and welcome to episode 9 of the Introduction to Forex Trading series. In this episode, we're going to be exploring the field of probability as it relates to our trading. Understanding probability is an essential component in a trader's journey, because we generate our edge in the market through means expressed by probability. So in this episode, we're going to be discussing different aspects of probability as they relate to our trading. It doesn't matter whether you're a new trader or an advanced trader. This lesson is going to be very valuable for you because this knowledge applies to all traders. So with that said, let's get started. The structure behind trading profitability actually shares a lot of similarities with a typical casino business model. To understand this structure, we first need to introduce the law of large numbers. The law of large numbers is a probability theorem which states that when performing the same experiment a large number of times, the average of the results obtained should be close to the expected value and will become closer as more trials are conducted. What this means in a standard probability situation is that the more data you have, the more accurately you can predict your probability figure, which in our case will be strike rate. The law of large numbers with regards to trading only works if the trials are executed in the same way each time. What this means for us is that your trades need to conform to a system or strategy in order for the edge to be quantified, which makes sense if you think about it, because we can't quantify something unless we have a set of parameters to assess it with. So in order for trading to be successful, there needs to be a set of predetermined market conditions which, when they occur, indicate an entry for your strategy. So what the law of large numbers is saying is that when you test a trading strategy, there will be a strike rate. And the more data which you collect, the more clear that strike rate will become. This can go on until infinity. To understand this, I want you to think about this. Consider a person who has a strategy and has backtested it 100 times. That person is going to have an expected strike rate based on 100 trades. Now let's take another person and say they've backtested 10,000 trades. Once again, this person is going to have an expected strike rate. But the only difference is their expected strike rate has been determined on a sample size of 10,000 trades as opposed to 100 trades. And so what you can see here is that that person is going to have a much higher degree of quantified clarity versus someone who's only backtested 100 trades. And the fundamental reason why is because of the law of large numbers, which states that as a sample size for data increases, so does the accuracy of the projected figure. Let's put this into a practical example. If you think of a roulette board, there are 18 red tiles and 18 black tiles plus 1 green tile. When you're playing roulette, you place a bet on a tile, and if the ball lands on your tile, you'll receive a payout which is proportionate to the risk of that tile. The green tile is a casino tile, so if the ball lands on the green tile, the casino wins. Now remember, you can only either bet on red or black, so no matter which side you bet on, the casino always has a statistical advantage, because there's an equal number of red and black tiles, but whichever you don't bet against gets the green tile with it, which is the casino. And so the key point is that at all times, there is a higher probability that the casino will win. And the way that this edge was determined was through probability analysis and the law of large numbers. A casino can run 1 million simulations on a roulette board, and in the long run, the end result will always be profitable. This is the entire business model of casinos, and we use the same concept in our trading. Because we know that we have an edge within the market, all that we need to do to make money is consistently execute the edge within the market. It sounds simple because it is simple. The more complex part is figuring out what the edge is going to be, but we've taken care of that for you with our strategies. Okay, so that was an extended explanation, but I wanted to make sure that you really understood that because as traders, we make our living by understanding probability scenarios. So there's really no such thing as too much detail that we could go into when it comes to probability. We're now going to step through a practical probability exercise which you can use to both enhance your understanding of probability and see how profitable Forex trading can be. To complete this exercise, the only thing you're going to need is a coin. I want you to flip a coin 10 times. Each time it lands on tails, write -1%. And each time it lands on heads, write on a piece of paper plus 5%. If you don't want to do this, you can just follow along with my test run. Here were my results. Plus 5, plus 5, minus 1, plus 5, minus 1, minus 1, plus 5, minus 1, minus 1, and plus 5. When we tally it up, the end result is plus 20%. Okay, so you might be wondering why we've performed this experiment. Let me explain. When you're first getting started with our strategy, you can expect a strike rate of around 50%. And we never take trades with a risk to reward ratio of below 1 to 5. And so you can see how this example relates to our trading. We are simulating our trading results in the market. And remember, that's only our minimum risk to reward. It can exceed that vastly. This example can be a good indication of how probability edges function in the Forex markets. The only thing you need to come out ahead in the markets is a probability-based edge which you can consistently execute in live conditions. The most important part of this episode for you to take away is that we can only make the law of large numbers work in our favor by executing the strategy correctly. The reason why is because if you don't execute the strategy correctly, if you even change one of the variables used to obtain the probability figure, the final strike rate will now become invalid, because you're now performing a new experiment with new variables. And so I say this confidently. The reason why 95% of traders don't achieve success in the markets is because they fail to consistently execute the edge without changing it. It's imperative that you risk the same amount per trade with the same entry criteria time after time. If you can do this, then you can be a profitable trader. It's not about winning one single trade, it's about being profitable over 1,000 trades. I'd really recommend writing that down because it truly is the difference between success and failure in the markets. So if you want to be a trader, find a strategy which is profitable over the long term, learn how to consistently execute it, and you can change your financial situation very quickly. So that's all there is to it when it comes to probability. I hope that this lesson was valuable for you. There's definitely some good value in here, so make sure to study it and you will be rewarded. Thanks for tuning into this episode, and I'll catch you in the next one where I'm going to be discussing risk management. Thank you.